Hey traders, Richard K from Price Action and Income. I hope you're all doing well and keeping safe during these challenging days we are all experiencing with regards to the coronavirus and the huge market sell-offs of late. Trading during these uncertain times can be very hard, so please exercise extreme caution if you are trading and make sure that you follow a strategy that stood the test of time before. Okay guys, so in today's video I decided to revisit the only indicator that I follow and use as an entry confirmation tool in conjunction with my market geometry techniques. So on my chart in front of you I have the MACD indicator loaded, which stands for Moving Average Convergence Divergence. Now most traders will be familiar with this popular indicator, and I have done a video before where I discussed the MACD settings I use and how this indicator is most commonly used by traders around the world. So in today's video, we'll not be going into these settings or common uses of this indicator, but rather how it can be used in a very different way to assist you in spotting the probable ends of corrections. Just know that I'm using the default settings on TradingView and that I only read the MACD histogram when I trade, which are these bars above and below these green and red histogram lines above and below the zero center line of the indicator. So before we take a closer look at how I use the MACD to count the probable end of corrections in a very particular way, I just want you to remember the following numbers, as you'll see that they repeat over and over again what I'm going to show you next. So remember, from now on we're looking at 3s, 5s, 7s, and 9s. Alright guys, so let's get into it. You'll see and probably recognize this ABC sort of pattern that ended on the 31st of December last year. It's something that I've been following for a while. I've also covered this symmetrical underlying price movement in a previous video. But obviously today we're just going to be talking about the MACD and how it can assist you to use it as an additional filter to figure out if you've actually got a strong case for an end of a correction. Now guys, I'm going to particularly use the MACD over corrections. Trying to follow this technique can be used in trending markets, but as you all know, that can be quite difficult as trends can go on for a very long extended period of time. MACDs can also show you divergence on whatever time frame you're following over a very long period of time. So they can be unreliable, but just remember, as long as we do see momentum divergence or slowing down of momentum into an area where market geometry or price meets market geometry is normally what I look at before I'll take a trade. So as you'll remember, before we looked at this this correction, I was only start tracking it here in December last year before I took a break. Price actually touched this upper median line. All I really, a channel line, and all I really did, let me just redraw that for you, was to draw a channel line from this low to that higher low and to that higher high there. And price basically just pipped that upper channel line. And here you won't see momentum divergences also while we'll be looking at different time frames, which is very important in this technique. But this is when I want to start showing you that how 3s, 5s, 7s, and 9s repeat quite often on a histogram or MACD histogram, and how it can help you to assist you with making trading decisions. Now, as you'll all know, I just labeled this in a simple A, B, C. I did not trade this low again, guys. I waited for price to decline at a retest here, and then we entered. We actually took a live trade with our EPS members on this position, and price just dropped down since from there. So without going into how the setup occurred, I just want to now focus on the MACD. You'll quite often find, and let me draw in, you'll see that I also use my pitchforks quite often. Now this was a shift pitchfork. If you use the modified shift pitchfork, it would be the same as this channel, and quite often just using various lines. If you were looking for a high, you could use different pitchforks or combination of pitchforks and channel lines and create a zone where you think, in this case, between this upper median line of the green shift pitchfork and this upper purple line of the channel, price did reach there and we had a reaction lower. And this is where you can start looking at a MACD, and you'll quite often find in corrections. Let me just number this, guys. You'll often see at the start of a move that momentum will increase, okay? And then obviously momentum would decrease, in this case price going higher, decrease going down, and creates a higher low. And then it goes up again. But try to count the actual how can I say, peaks and troughs of this MACD histogram, and you'll see that we had 1 over there, 2, price went below the MACD 0 line, and we had a 3 going into that high, which is a number you'll quite often see repeat over. Remember, we're going to look at 3s, 5s, 7s, and 9s. And we're going to switch in this example to a 4-hour in a short while, and I'll show you something else as well, where I think it's a 7 repeats itself quite often. So we have a trough 1 above, so you count green as number 1, red as number 2, and 3 going into this high as a number 3. And guys, if this sounds strange or weird to you, we'll start looking at other examples just after this, and you'll see this repeat over and over again. You'll see here that we did not have any momentum divergence on a daily, and this is why we also like to go and use a smaller time frame. Normally, if you look at a daily, we like going into a 4-hour chart. Let me just get to that same area, and you'll see that although we had 3 waves, and there will obviously be multiple ones using your MACD in this case because we went to a 4-hour chart. But what is quite interesting here is that on your 4-hour chart, as an entry confirmation, as price hit this upper zone that you identified or should have identified before, you had a slowdown in momentum, which was a signal to most probably take a trade. Sorry, let me just change that to red. So we had momentum divergence on a 4-hour chart at that high. As you'll see, price approached with a decent momentum, and as it made this high, it slowed down the momentum and almost went into the negative below the 0 line, and that was a high. We even had what I call a bearish flank doji formation at the top there. But let's quickly get rid of these numbers again and also show you this occurrence of what you can find on a MACD as you even look at all these waves going up, in this case, using the MACD again. So if you were tracking this low, remember we're going to look at 3, 5, 7s, and 9s. We got 1, 2, 3, 4, 5 into this high, and we get a correction lower. Okay, so we got 5 into there, 6, 7, which was the high. So this previous we looked at the daily over this entire correction. Here we're just looking at this leg up, and we had 7 counts into this high. All right, and this is where you can also look at declines. We had 1 decline, 2 declines, and a third sort of decline here. You can actually go 3, 4, 5, 6, 7, 8, 7 in this occasion, sorry, before price goes up again. And the main thing is to actually look at these occurrences on a higher time frame. The higher the better. I don't really like doing this on a smaller time frame, like an hour or 30-minute. The larger the time frame, the more accurate this gets. But since we were watching for this high over here, and we were expecting a probable reversal at that high that we identified previously, it would make sense to count at least 3, 5, or 7 into this high, which we did. Forget about this. Price didn't reach that high yet. There were other techniques that we knew that we should follow, waiting for another leg low. We didn't enter over here. We only watched for this high to occur over there. And this is where we could then follow the second leg. When I mark this as an A, B, and a C final over here. And here we go again. We got 1, 2, 3, 4, 5, and it never made a actual 6. So we got 5 here, and let's repeat previous one we had 7, and in this case we had 5 times into that high. Guys, it's an additional way that you can count things. Let's look at more examples, and you'll see that this repeats over and over again. And this works for most markets, but just remember, like I mentioned before, that I do like seeing these things occur on a higher time frame, like a daily or a 4-hour chart. Now, this is just an example. I did take some of these trades. I think I took this trade here in the beginning on April 2019. This was a simple ABC correction, a minor one in this case. We had an ABC. Price ended at the upper median line. This was again a daily chart, no, there was no counting that could have taken place here, but if you went to a 4-hour chart, so into this high here, we got starting off 1, 2, 3, 4, 5. Like I mentioned before, that's normally a number where you can get something happening. We have an A, B, C down, which was 1, 2, 3, 4, 5. And then we had this last leg to the upside. Starting from this low, we got 1, 2, 3, 4, 5, 6, 7. And there we have the 7 in this case. 9s do appear, but you'll quite often see that your 3s and your 5s occur quite often. We had 7 waves, counting the MACD above and below the center line into that high. We also had a small of an inverted hammer candlestick pattern there, and you'll also find that there was slight momentum divergence between these peaks. That was just an example, guys. Let's have a look at another one, just to show you that this happens all over the time, or repeats quite often. Daily time frame going again. Here's another occurrence, although it was quite a long wick here. This was just a simple ABC to the upside again. Here we go again. 1. That little red little bar at the bottom here is below. 1, 2, 3 into a high. Price came down. This was something I was watching, but I missed it because I wasn't wide awake on this one too much. If you went from there to there using a shift pitchfork, yeah, we could have said that price hit the center median line. But quite often, if you do use market geometry, you see long wicks, you should use the opening or closing prices. And in this case, you'll see there where these two confluenced each other. We had a momentum divergence between this peak and that peak on a daily time frame. And it also reached the upper median line of the shift pitchfork if you use this opening price and not the actual wick. And there we go again. We got 1 little red to below the 0 line, 2, and we got 3 into that high again. Here we can count it again. Although this was a complex move, this was probably a expanded flat correction. You'll see that price started with from this low with decent momentum. We again go 1, 2, 3 into this high, and price reversed slower. Then we got another one of my favorite patterns I like to trade, which is symmetrical triangles. We also got different versions of that, like ascending or descending triangles where you have flat tops or bottoms. But in this one, we had price coming down. We had an A, B, C, D, and E. Price ended here. And this is where we'll have to use your MACD in a different way. As long as you are tracking, in this case, a downtrend, if you think you're dealing with a triangle correction and price is going to go lower, you quite often want to see divergence between these lower highs. In this case, lower low, lower high, lower high, lower high before price comes down. And you'll see that normally between those peaks. And your final E wave peak, let me just label that for you. You'll quite often find your MACD showing you divergence between your A, C, and E peak, obviously for, in this case, a bearish market. And guys, I can go on and on and on like this. You'll quite often find that, not quite often find that as long as you are using market geometry, remember I'm only trading when price interacts with my market geometry lines in most cases, a confluence of multiple market geometry lines. But if you can then use a daily time frame or a 4-hour time frame, and remember to count the peaks and the troughs of the MACD on either your daily, if it's not showing on your daily, then switch to a 4-hour chart and then look if you can count those numbers into the highs or in the lows, depending on which direction you want to trade. And if as long as you can count 3, 5, 7, and in some cases 9, into an area where you identified beforehand, before prices reaches there, and follow then additional other entry techniques, then you've got a pretty watertight case that you might get a reversal. And you'll, like I've showed you in only a few of these examples, these things occur over and over and over again. And it's just a very cool behavior that the MACD does display all the time. And like I said, 3, 5, 7, and 9s, if you can count either the individual legs from a higher time frame or from a lower time frame into a high that you want to trade, and you see one of these numbers pop up, and especially then see in any sort of reversal candlestick patterns and momentum divergence, very importantly, then you've got a high probability trade setting up, and then it's just up to you to take the entry. Okay, guys, I hope you enjoyed that video today. Please do put some comments in the section below if you want me to have a look at some of your charts, and please mark them out if you want me to have a look at them. And also don't forget to hit the subscribe button for more insightful videos in the future. Until next time, guys, this is Richard from Price Action Income. Goodbye.